Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 16, Investing 101 Stocks. Okay, on today's episode, I'm going to talk to you guys a little bit about stocks and what it all consists of. So what is a stock, you may ask? A stock is basically a ownership of a company. So basically, if I have company X, or if I say I want to have a company in surfboards or something like that, for example, surfboards, and say I have $100,000 in it, and I want to grow that money to maybe $200,000, but I don't want to take a loan out from the bank. What I can do is offer bits and pieces of my company out of 100% out of a pie circle, if you will, to the open general public and say, hey, does anybody want to invest in me? I make high quality surfboards. Things are great. I would really like you guys to invest in me, and I would like to see what you guys can do. So I would divvy up maybe 10% of my company to each person who wants to invest in certain amounts. And in doing so, now they are becoming shareholders of my company that makes surfboards. Now, say one person puts in 10,000, another person puts 10,000, another person puts 10,000, and you have say 10 people who put $10,000 in at a time. Now you have an extra $100,000 that you can buy more equipment, you can make more surfboards, maybe different colors, put some technology in it, do all sorts of stuff. And what happens is those people who own a little bit of the company are, like I said, shareholders. They own part of the stock of the company. They are investing in it, so they own stock of it. So when you make money off selling your surfboards, they also make money off of selling the surfboards as well, because they are part owners of it. Now, it doesn't mean that they control the whole thing, but they in generally have a responsibility of sharing in with the profit. So if you make money, it's your responsibility to pay those shareholders a certain percentage, say 10% of the earnings, because you've made some money. Now they need to earn some money. Now it's up to the shareholder to do what they want with that stock. They can take that stock of their percentage of the stock of the surfboard company and sell it off to somebody else. They can cash in on it, meaning sell their stock, and then they can, if it's making money, they can pull out and say, I'll take my $5,000 in profit and just walk away, meaning the money that they had now goes back to the company, goes back to you. They can resell it to somebody else, etc. So owning a share of stock basically means owning a little bit of the company. You're entitled, so you can go to Google, Facebook, I don't know, LinkedIn, McDonald's, etc., whoever, and you can invest your hard-earned money into a little bit of their company in hopes that they're going to do well. Now, the main thing is a stock can go up and down and all around. There's no right or wrong reason for which way a stock can move. Things do happen that do change effects of a stock. So, for example, say there's a bombing that goes off in London or whatever, or something like that. God forbid. I hope not, but or maybe there's an earthquake or something like that. If the earthquake destroys the surfboard company, for example, well, now there's a problem that we can't make surfboards. So maybe a lot of shareholders are going to get nervous and say, oh, well, we can't do anything, so I'm going to pull out my money from that stock, from the shareholder of the surfboard company, and that can cause the stock price to go down because the company's, under rubble or cannot produce the materials or whatever. So stocks can go up and down. So maybe there's an influx of, of surfers in a certain area. Maybe like, oh my gosh, this is a really good booming area. There's a new product that's out there that's going to make the best surfboards in the world. And there's a lot of hype around it. There's a lot of news media. There's a lot of, the hurricanes are drafting up big, things of swells of water and all that stuff for great surfing conditions, etc. Big articles or magazines are being posted. These things can hype up the excitement of making surfboards, so which will generate a lot of excitement for people to want to invest in your company to make profits in hopes to make profits of making awesome high quality surfboards. So that's basically what a stock is. It's a small share that you buy, or you're investing in another company in hopes to make profits or gains from that. You can make profits on the way up, or you can make profits on the way down, and I'll explain that in a little segment later on when we talk about the different parts of a stock and how to do the bear and bull markets. So moving forward, so a common stock is basically open to the public. It's a general open, it's a commonality, it's common stock. Everybody can go into it and invest in it. There's one that's also called preferred stock, and preferred stock is basically stocks that are preferred to certain clients who invest a high or large amounts of money to a company, and they expect a certain amount of dividends. And what a dividend is a return on their investment prior to the common person. So if I put like say $10 into a company, and somebody puts $100,000 into a company, they could be a preferred stockholder. And when the profits go up in a company, say the surfboards, for example, they will be preferred over me because I'm a common stockholder, not really investing too much money in it, and they will receive the gains first because they put a lot of money into it, and or any dividends or interest or things like that first that have been involved on top of their money first before the company decides to pay out any dividends or any earnings on to me, to the common shareholder. So preferred is first, and then common is to pretty much everybody else in the general pool of things. So it depends on how much money you put in and if you want to be a preferred member or you do not. All right, so that's common versus preferred stockholders, different voting rights. I guess preferred has different voting rights, so they can vote higher and they can sort of persuade, what they want to do with the company. They have rights. They can go to, usually when you invest in a stock market or a stock company, you will get the earnings report. You will get a sheet telling you how the company's doing, what are they spending their money on, what technologies they're looking forward to buying. It's basically a report of what their company is doing. So when you do that, you can find out what's exactly going on with the company. And it's quite exciting to see, are they headed in the right direction, or what do you feel is, are they maybe not making the right moves because, maybe surfboards aren't in style anymore, I don't know. So they like to give out their reports. And usually when they have dividends, which is earnings that they kick back and sort of divvy up a little bit of earnings to everybody all at once, what they end up doing is, it's called a drip stock. Drip, I forget what it stands for right now. It's, where was it? I have it on my sheet here. It says Dividend Reinvestment Plan. So DRIP, Dividend Reinvestment Plan. And what it does is basically when the company makes money, it's going to reinvest the money that you've earned into the stock, so it makes your stocks grow a little bit more. So dividends is another great way to make money in a stock market. So for example, I have $10, I buy stock X, and the stock goes to $15, and instead of pulling out, this company says, well, we'll give you $3, and just because for investing with us, we love you guys. You gave us $10, I really appreciate that. They will give us $3 just because we've invested in them and are a loyal stockholder. They will give us the $3. So now my total investment of the $10 that I put in now becomes $13, and then on top of that and I can reinvest it into the same thing. They just say now instead of 10, it's a value of 13. And then if they do it again, another dividend comes out. Say this time they give $2 of interest, and for being a loyal member, now I have $15 of free money that they, technically $5 of free money that they've given to me as a loyal member of the stockholder. So if dividends are great, look for them. Different companies offer higher yields of dividends that they divvy up to the entire public. Say for example, Apple has dividends, but if depending on how many they have to spread out, the number might be lower or higher. If they have lower shareholders, they might say, all right, well, this year we're going to give out $100 of dividends to each share member, each person who owns a share of stock. Or if there's maybe a lot of people who own a lot of shares of this company, instead of $100, they might say, well, we'll divvy up and we'll give $10 to everybody as a thank you for investing in us. So dividends are a great way to make extra money from the company as a thank you for being a shareholder. All right, moving on. Companies can break up their company into different sections so they can have different qualities of stocks. So say, for example, back to the surfboard example here, I could say I have another company X that also is part of the company, but that just makes the fins of the surfboard, the stabilities of the fins here. Now that could be, say, I don't know, let's just give it a number ABC surfboards, and this company is going to be called XYZ Class D or Class A or Class C of this ABC company. So ABC Class A, ABC Class C, ABC Class D, etc. It can be the same company but just broken up into different sections for the products that they make. And you can invest in a variety of them, like say Berkshire Hathaway, BRK Class A stocks, or Berkshire Hathaway Class B stocks or Berkshire Hathaway Class C stocks. And each one of those companies do a little part of the whole thing of the Berkshire Hathaway group. And they may invest in parts, or another company does the technology side of things, etc. So those are some different classes of stocks that you can look into of a certain company. The next thing is markets, different markets of stocks. Where do you trade these things? They have different market shares that are out there. The New York Stock Exchange is one of the largest in the world, where a lot of common stocks are bought and sold. It's basically a marketplace where people go and exchange things. They exchange goods. Hey, you buy my stocks, I'll sell you mine, and you do this and do that. And that's where people congregate to sell things. Now, with the aid of technology, a lot of people do this online, using certain software tools such as TD Ameritrade, Fidelity, E-Trade. There's a whole host of them out there, and those are pathways to basically trading and selling stocks and buying and selling stocks that are out there. So that's different stock exchanges. There's New York Stock Exchange, Amex, American Stock Exchange, the London Stock Exchange, Tokyo Stock Exchange. There's a lot of big key ones that are out there. So usually what you can see in fluctuation is when one market does well overseas, for example, usually they tend to follow one another. But say, for example, it's a big earthquake or something's economically going wrong in another country, if a stock market goes down, in say London, it might affect, how the buying and selling of trades in the United States, because now, something happened over here that's now affecting this one. So they all are tied together in this little string, virtual string, if you will. So when one affects the other, they all kind of flow. So when one goes up, maybe the other one tends to go up like this, and it always tends to go up and down. And when it goes up, that's called a bull market. Bull meaning like it's the horns of the bull go up. And then when it's called bear, you're clawing down towards the bottom. So the bear market tends to go down. And usually it goes up and down like this, and it rides just like this. It kind of goes up and down. Recently, the markets have been tending to gravitate towards the bull side and gradually going up. And usually when things go up very radically, then they tend to come down very, very harsh, just like a roller coaster ride. So be prepared for that. And I'm going to talk to you about safety concerns when it gets into stocks, and what to watch out for and how to protect yourself using stop losses and things like that. All right. Moving on. So I talked about different stock exchanges. The NASDAQ, for example, is a group of technology stocks that can be traded. Apple's, the Microsofts, Intel's, LinkedIn's, the Facebooks, etc. That's traded on the NASDAQ stock exchange. So when the technology sector goes down, generally speaking, those companies all go down as a whole. They kind of like, the small ones get hit hard, and then the bigger companies kind of like, whoa, there's a slowdown in production of Intel chips or some kind of processing things that are going on, or maybe the screens of computers are having a big hit right now because of an earthquake that happened. I keep referring to earthquakes, but things like that can happen in the stock market. Supply and demand. It all comes down to supply and demand. Trading is what it's all about. Trading. How many surfboards does everybody need? Is there a huge supply of this, or is there a huge demand of these things, or is there not? These are things that need to be considered. So if there's not a huge demand for these, the stock of this value of this company, Surfboards ABC, is going to go down in the stock market, and the value is going to go down. But if there's a huge demand for them and everybody wants one of these things, the stock's going to rise because hey, I wanted this, I can see a value in this, I want one, I really, really want one, and the stock tends to go up. Now, usually time is a factor in this, and the longer the company's been around gives it a stronger backbone and a stronger vitality, I guess, if you will, of the company itself. So if this surfboard company, for example, has been around for quite a while, usually about, say, 30 or 40 years, there's a long, strong revenue saying, hey, that company has been reliable. They've been in business for a couple generations. They've been, their stock price has been steady. And they're constantly innovating, and they're showing strength as a company that's been around for a while. These guys have not gone anywhere. They're obviously been successful. Things like that can play a big factor into a stock price's value and where they might be headed. If a company's only been around for maybe a year or two, yeah, they might not have a lot of grasp, or they haven't really planted their roots into the ground of the common people. Not everybody might not know them. Maybe not a lot of people know about the surfboard company that say I started or whatever, something like that. So, for example, that's an example of time that could be on somebody's side when it comes to owning a stock in a company that they might feel that they want to invest in. Um, Earnings, so when expected earnings come out, usually the earnings come out in quarters. So every quarter there's an earnings report that comes out, says, hey, how are we doing with the stocks? Are the stocks doing well? Or is the company doing well? And can we give back to those who invested in us, as a dividend, as it were, a drip stock? Or can we, are profits doing, what's the outcome of the stock? Have we made progress on selling surfboards, for example? Or have we made progress with the technology side of things? Or maybe this earning was just a slow market. Maybe we have to explain to people, although we have a high outlook and we'd like to stay in business right now, not a lot of people are buying surfboards, for example. So those are some things that you have to expect as an earnings report, and it could be, say, our earnings are expected to grow maybe 50 cents or a dollar or $2, or maybe we're slowing down things and we're gonna have to lay off some people who are in making of the surfboards, and we're gonna have to bring everything down a little bit and decrease our stock value and sort of lower it down. Instead of being maybe say our stock value is $10, maybe we have to lower it down to maybe $7 or something like that, and hopefully regroup and regather ourselves and try to regrow that up and keep expanding and making our products better known to the public and try marketing skills, etc. And that's pretty much how stocks work. Price times the number of shares outstanding, or market capitalization, is the value of a company. So the number of the price value and how many shares have I divvied up to everybody, and is the determination of what a stock's value is. All right, so what else do I have on here? Again, stocks are volatile. They can go up, they can go down. There's no right or wrong for them. Stocks is equivalent. Let's see here. You can lose all your money with stocks. If, say, the stock tanks. So what happens is, say we're going out of business. We have not sold a lot of these. I gotta pull the plug. You can lose all your money as a shareholder if you don't sell it quick enough. And if you are a preferred member, what would happen? Preferred stockholder, I would have to pay the preferred stockholders money first if they're selling their stocks first before I give it to the common person and give their share. But you can lose your money. Stocks are volatile. They go up, they go down, and they go sideways. So be aware of that. And just before you invest in a stock, make sure you do your due diligence and research a stock and find out, how long have they been around? Are they what are their earnings reports? What's the general vibe of it? Don't just go based off the news. The news will be a terrible way to look at something, because by the time it hits the news, it's already happened. So I encourage you to do your research, find out what's going on with the stock. Paper trade first, as I talked about in the last lesson. Always practice, practice, practice. Another tip that I can give you guys for learning about stocks is a great company that talks about it is Possible Investopedia. There's you can just Google about stocks, on YouTube. You can also check out Grok Trade, free online trading education.com. It's fantastic with Des Woodruff. He's a fantastic guy. Hey Des, what's going on? He teaches people how to learn about stuff, and I've used him quite often, and I love his training videos, the 101s, the 201s, and possibly going on to the mentorship for myself later on, because I've been learning about stocks with him. As well as Sashna Egnikov with TradersFly.com, which is a fantastic website, and he does a fantastic job of explaining things and getting people to learn about different ways of how the market moves. And if you have questions, he will guide you as well. So again, hello Sasha, and he will reply to your emails. They're those two guys are the ones I've been working with, but I'm sure there are others that are out there. You just gotta search around, do some searching on stocks, how to invest. Again, paper trade first. Do your research. Find out. Practice with it. Have you start to see the trends? Have you start to see the numbers? Are you able to digest everything? So take a look at that and look at where you can buy stocks. Using go to TD Ameritrade. Take a look at E-Trade. Take a look at Fidelity. Those are different platforms or avenues that might work best. When you buy a stock, there might be a transaction fee that might occur. So when you buy something, in order to buy it, it might cost you $10, and when you sell that thing, the stock, it might cost you another $10, which is called a transaction fee, and the grand total that is $20 per transaction. So you have to factor that in when you buy a stock. So that's one of the big things a lot of people forget. Is, like, oh, I made some money. Well, you made some money, but don't forget, you also had to deduct that $20 transaction fee, $10 to get in and $10 to withdraw from a stock. And how many stocks do you want to buy? Do you want to buy a lot of stocks, or do you want to buy a few select ones? My advice is to you is to keep it small, keep it simple. Maybe start off paper trading with one or two trades just to see how it goes, and then as you get more experience, you shouldn't have more than 7 to 10 stocks at all times. Because then it becomes too much to manage, too much to look around at, and it's not viable to look at those stocks in a nutshell, because you not look at one and then look at the other and concentrate on one and then forget about what the other one is. Keep it small, keep it manageable, and then make the profits on what you know, and you start to feel a vibe for a company, and you say, hey, I know that their product is going to come out next week for, say, GoPro's new camera or something like that, and I know that's going to be a rock solid hit, and maybe that would be a great way to invest in early and see the stock rise and then capitalize it and then get out at the top when everybody's put in their money and you feel that the company's made its profits, and then you can pull out and then claim your a little bit at a time. It's not about the money itself, it's about going after the percentages. Okay, the biggest tip I can tell you is when you invest in a company or buy a stock, it's not about whether it's $10 or $100 or $500. It's the amount of percent that you can scrape off. And my advice to you is, invest in a stock, wait till it goes up to 5 or 8%, and then pull out. Pull out when it comes out to around 8%. You can scrape off a little bit at a time, start gathering. But in conclusion, stocks are small ownerships of companies. I wish you the best of luck. Do your research before buying a stock. Paper trade first. And practice. Okay, the best method to learning about the stock trading markets and learning how to invest and stuff is to practice, paper trade, and research.